Hey guys, Mike here. So obviously what a dreadful day in the market, and boy, it went down quick on not one, not two, but really three things that happened in the market, which we're going to touch base on. I'm also going to go into, because somebody asked me to, talking about what this possible liquidity crisis in the treasury market would do with the Fed, which I think we know, but you know, what's happening in that part of the market, and I'll try to touch base on that. And then I was also going to talk about, you know, something nobody's really talking about, which is the Fed balance sheet, which is actually starting to pick up pace, by the way, and I'm going to show you. And then we'll end it with listening to, you know, an investor who's been doing it for a long time, who's a billionaire, and what he's predicting for 2023. I did want to start by saying, before I put yesterday's video out, I told my wife, I said, you're going to see some fiery people in the comments, which is great, because I like to get the juices flowing with a good debate. But anytime you go against the grain and tell people you might want to be open-minded just in case A, B, and C happens, people come out in droves, and it's good, and I love it. It's absolutely awesome. And I did write some down here, what people were talking about, because I said, you know, if A, B, and C happens, which, by the way, the first one was a report today from the the Department of Labor, that if unemployment went up, right, that would be the first checkbox. Obviously, that did not happen. So forget about that. The next one's CPI, right? But of course, people come out in droves and say, you know, if I say you can get a 2 to 3 month rally or whatever, be open-minded to it if A, B, and C happens. But, you know, Gray Wolf put in there, he talked about inverted yield curves, why this can't happen. And, you know, I've talked about inverted yield curves till I'm blue in the face, but I'm actually thanking him for saying that, because I'm going to do a members video like I did this morning, but talking about inverted yield curves, because everybody thinks because an inversion happens, that's all you got to know. There's a lot more that goes into it than that. And the 3-month, 10-year hadn't even inverted yet, and that's the more accurate one. So I'm going to do that for the members. I promised them that this morning. The other one was interest rates. I've talked about that, and I'm blue in the face. And yes, a bear market, I've told you before, it never bottoms, it never has in history until the Fed is done tightening, right? The one nobody talked about, which was the balance sheet, I'm going to get into today, because you definitely need to see that, because I think that's even has a more of an impact on the United States here than the actual interest rates do, believe it or not. Mikey talked about how we're already in a recession, and Mike, no doubt you're right, paper recession for sure, technical recession, whatever you want to call it. But those of us who are old enough who've lived through real recessions knows that there ain't no real recession having 3.5% unemployment with people still getting rising wages. And maybe certain pockets of the country feel like that's happening, but in my area of the woods, not happening. All right, most people I know, not happening. All right, and I mean, Amazon in my area is hiring thousands of people for the holiday stuff, and Walmart's doing it, and you know, people still getting pay raises in this neck of the woods. So maybe in certain parts. But we all know what a real recession looks like. We all know what the dinner table talk sounds like when you're in a real recession. All right. And certain definitely income levels feel it because of inflation. For sure. There's no doubt about that. They're being destroyed. The other one was the VIX not going over 45. Somebody said, I said that before. I'll reiterate it. In a bear market, we've never actually had the bottom until the VIX spikes 45 or higher. For that to happen, you're going to need some kind of liquidity crisis, which we're going to talk about, or something to happen, right, for that to take place. And it has to be on the S&P, not the NASDAQ 100. I showed you in detail bottoms before the S&P. And that's because of those oil stocks and all these other stocks that just aren't traded on the NASDAQ. They're usually the last ones to go because you're in a real recession and demand is falling off a cliff, okay? So thank you for all those comments. I really appreciate it. Again, I'll do the detailed members video for the inversion and stuff like that and let you guys know. I promised them that this morning when I was doing the video for them this morning. And you can see the biggest one that started the whole thing was AMD comes out and says they're going to be short on their sales, not by just a little bit, by close to $1 billion, because PC sales have tanked. This is what NVIDIA said, and I think Intel did as well. And so that started, and you can see the brunt, boy. If you're in a semiconductor stock, my goodness, they took a pounding today. I mean, way down. AMD down to 13. Like I told the members this morning, hey, you're going to be looking at buying NVIDIA under $100 some point in time in the next 12 months. AMD and probably in the 40s, if not lower. So, you know, it's going to be a great buying opportunity. And then, of course, you had the unemployment report come out today from the Labor Department. And oh boy, going down, not up, from 3.7 to 3.5. More jobs created than they expected, even though it did slow down for the month compared to the other months. But it is the exact opposite of what the Fed would actually have wanted. So that just, boom, that took the whole pivot thing right out of the window. And of course, the market reacts to it and continues to sell off all day long. The other one was oil. It was at 90 when I did a private video for the members. Now it's at 93. It's going up, I think, 20% in 10 days. That's not good, right? Because that makes everything go up, right? I'm talking about food costs, transportation costs, fertilizer stocks, all that stuff. It just makes all that go up. And so that's a problem, right? That is a problem. And so that's something else we're dealing with. And the people that probably hurt more than anything today, and you're really hurting if you were holding those the 3X leverage ETFs and hoping to go green versus the inverses, which did great today. So congratulations to you if you hold SQQQ, which I know a couple of you do. You said in the comments, or anything to do with semiconductors and stuff like that. And it kind of does feel like you're sitting there thinking, is this the moment? Is this the moment the market breaks, right? And the Titanic goes under? And I'll tell you what I'm looking at Monday real quick. I'm looking at certain stocks like NVIDIA, which you can see sitting right there on that support level. And I've told you these support levels is 12% down for each one of them. And it just doesn't have a lot of support on these levels because it went up so fast in 2020. There wasn't a whole lot of consolidating at all. It just rocked it up. And so, it's going to be a big drop if it starts breaking these levels. And then there's Tesla with this trend line where it got rejected once, but then it bounced off of it for support around 6 times and is sitting right on top of it today. And so we're going to see if it breaks through there or not. That'll be huge. And don't forget to hit that like and subscribe button, guys, if you get something out of this. And so, the one thing I want to talk about is, and there's other stocks, by the way, that are sitting on support levels I didn't put in here, but I'm trying to keep the video as short as possible because it's Friday. And, is somebody talked about, what about the balance sheet, right? And the balance sheet is what, to me, not getting enough talk, right? But it's finally starting to pick up pace. And you can see right here, the Fed, in the last 3 weeks, they've done 70 billion. That's the fastest pace they've had in that kind of time frame. But it's down 206 billion. And I know compared to the overall balance sheet, it's nothing. But in this fragile market, it is definitely something. And especially when you look at the trajectory of it. Because remember, this will be tripling this every month, running this balance sheet off with the mortgage-backed securities and their bonds. But look at that trajectory. We're talking about not billions, but trillions supposed to come off in the next 2 to 3 years. I don't know if they're going to make that or not, or have to pivot because, liquidity is going to become a big issue, I think. I think it's already there in the treasury market. You can see it spiking as high since 2020 right now. And so higher number indicates worse liquidity. You can see that's been going up, and it makes sense that that's going up because what's happening? You got the biggest purchaser of bonds and mortgage-backed securities, which is the Fed, that's been going on for a decade. They were purchasing, even when things were supposed to be hunky-dory in the market, they were still buying that stuff up like it was hotcakes, right? So they're the biggest purchaser of both. Now all of a sudden, they're not purchasing any of these, and they're letting the other ones roll off the balance sheet, right? So you got a double whammy going on in the market. And when do you have a liquidity crisis? When you have an imbalance of buyers and sellers. And that's what's been happening. And that gap is getting farther and farther now. And that's why you're seeing yields all over the place because they have to attract buyers, right? Like, who wants 2%, 2.5? I can get 4, maybe 4.5. You got to attract people to get in there and start buying this stuff. And the reason why it's huge is because that's how our federal government works, right? I mean, we don't pay anywhere near amount of taxes to fund what we spend. I mean, it's either $1 to $2 trillion gap in that. And so they have to issue debt, right? You see state governments do the same thing. Localities do the same thing for certain projects. And that's where running this balance sheet off is going to be pretty tricky to me. I can't imagine they're going to do it for long before something breaks. I mean, with interest rates going up, with the balance sheet rolling off, we know the end of this movie, right? I mean, don't we know there's going to be a liquidity crisis, whether it is made by what the Fed is doing or it is man-made by these fund managers getting together and creating one, right? I mean, not that they would ever manipulate the market to get what they want, but can't you just see that? And so that's a liquidity crisis. Buyers and sellers aren't in line, right? You got more than one than the other, and you just lost your biggest buyer. It's going to take a whole bunch of people to pick the slack up. And the question is, do they want to? That's really the other one. And so who knows where rates are going from here? But understand, if you have a mortgage, credit card, car loan, that price is all tied in to those treasuries somehow, some way. Okay, and so that's why it's a big deal how high they go. But the one thing I also want to talk about was Stanley Druckenmiller and what he's thinking about 2023. He's a billionaire, became that way being an investor. He still manages his family portfolio, which is over $1 billion, I think, if I'm not mistaken. And so he's talking about 2023 when he sees a recession, what kind of recession he sees, and also something that Janet Yellen's been doing, which is kind of shocking.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad. Why? Because if you look at the liquidity situation that has driven this, we're going to go from all this QE to QT. We're following an asset bubble. We've been doing all this running down on the SPR, which is now, that's the Strategic Petroleum Reserve. It's now below 84 levels, even though obviously oil consumption is much higher. We've had a bunch of myopic policies that have actually delayed the liquidity shrinkage. QT has been almost entirely offset by Janet Yellen running down the Treasury savings account. By the way, pretty amazing policy. She could have sold 10 years for under 1% during this time. Instead, she runs down the Treasury savings account. So all that has masked the liquidity shrinkage, but it really comes into full gear. And she can continue this for a while. We can do the SPR for a while, stimulative stuff. But by the first quarter of 23, it kind of goes the other way. So our central case is a hard landing by the end of 23. But I don't know. I've been wrong on a lot of things. I could be wrong on this, but since I do it for a living, that's our forecast, which is a recession in 23.
There was a time you went to college campuses and you talked about an equity and debt. I think in this case, it wasn't necessarily Fed-induced, but it was entitlement-induced. Yeah. And it could come, this was 10 years ago, and I think you said sometime between, Nostradamus. You said 2020 and 2035.
Yeah.
So it's is it 2022? Is it happening?
We are in deep trouble. So everything I said at those colleges is worse in terms of the metrics, except for one thing. And what I miscalculated was I didn't calculate zero rates, I used 4% rates. But the only thing Donald Trump and Hillary Clinton agreed on in 2016 was don't cut Social Security, don't cut entitlements. So nothing was done. Joe Biden has excoriated Rick Scott because he dared mention maybe we shouldn't be increasing senior pays. But if you look at the reversal I just talked about, and you use the CBO estimate, which is rates at 3.8%, which I think, frankly, is pretty optimistic, given all the things we've talked about. By 2027, the interest expense alone on the debt eats all healthcare spending. By 2047, it eats all discretionary spending. So we're now getting into fiscal dominance. By the way, by 49, it eats all Social Security. We're getting to the point now where the interest expense on the debt is so high that it's going to eat up our ability to basically service the next generation. I'm not even sure about the current one.
And in a nutshell, what he's saying is, an old saying where I'm from is, the roosters always come home to roost eventually. You can manipulate, you can do whatever you want to try to do with those oil reserves and what Janet Yellen's doing and all this other stuff. But eventually, somebody's got to get paid in a way. So and it's scary. I've actually done a research paper when I was getting my MBA on Social Security and entitlements and the federal budget, and it is some scary stuff. I actually encourage you not to do it just because if you're one of those people who get stressed out easily, don't even bother. Don't even think about it, because the truth is there's nothing you can do about it, because all you're going to do is keep voting in the same people anyway. So it don't matter. They're the only ones that can do anything about it. And if you keep voting in the same people, they're just going to keep kicking the can down the road to keep getting reelected and making you feel good. So, that's where we're at on that. But I did want to put that out there. But as far as like the Treasury thing, yes, it is. Come on, guys. Let me know in the comments. But don't you think if we keep going this route, which we have to get inflation down, but don't you see either a man-made or what they're doing kind of a liquidity crisis happening either this year or next year? And of course, what do you think the Fed's going to do? They're just going to let something fall and let a pension fund go under or whatever? No. It's not going to happen, right? And so we'll see how that goes. But imagine an example is this: losing your biggest buyer like that, in any sector. Imagine BlackRock, they buy a lot of single family homes, right, to rent them out. You'd be surprised how many. And imagine let's say they buy 1 million homes a year for 10 years. That's the equivalent of what the Fed did with Treasury and all that stuff, right? Just trying to give you an example. And then all of a sudden they say, you know what, we're not buying a single family home from here on out. And a matter of fact, not only that, we're going to sell 2 million family homes off of our balance sheet every year. That is 3 million, right? 1 million they're not buying, 2 million they're selling. That's going to be hitting inventory, right? So 2 million is going to come on for inventory. They're not buying 1 million, right? So all of a sudden, but guess what home builders are doing? Because they have to get the permits, have to be well in advance to build all these homes, right? They're going to keep building. So the supply is going to continue to do this right here, and it's really going to spike up when they start selling those 2 million homes every year, right? That's a lot of homes. And now they're not buying. So what do you think happens to the real estate industry when you lose your biggest buyer? And not only that, they become maybe one of the biggest sellers on top of it, right? So that's kind of, just think about that. Would that be good for the real estate market or bad? In this case, it actually would put on a lot more, it'd probably bring home prices down, so it might be good now. But I'm talking about in regular times, what would that do to a normal real estate market? I don't think it'd be good. I don't think it'd be good at all, right? And so that's kind of what you're seeing in the treasury market right now and mortgage-backed security market. And I even saw a guy who's in the mortgage-backed security market doing an interview, and he said they bought the Fed bought so many mortgage-backed securities over the years that if they try, there's not enough companies out there that in this business, if you combine them all, they could buy what's on the Fed's balance sheet. They've just went crazy doing this. I mean, it's insane what they've done. And of course, now we're paying the price for it. Imagine that. It's amazing how that works. And so that's where we're at, guys. Just want to put that out there to you. But, it's fun times. We'll see what Monday brings. Obviously, if Monday goes red, that means we go probably back below the June lows, depending on how low it is. Usually when you have a sell-off like today, you kind of get some kind of reprieve. But in this market, you never know, right? So we'll get it. And don't forget, we get CPI next week. So it's going to be another fun, volatile week. That's the only thing that's certain right now is volatility, all right? So good luck. Enjoy your Friday, the rest of your Saturday, and I'll see you Sunday. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. Think about sharing the video. As always, guys, thank you for all your support.